Hey, what's up, everyone? My name is Ale. Welcome back to my world of stocks. In today's video, I am basically going to make a sort of like a free course here for you guys, really for any beginners out there in the market that want to build up a dividend stock portfolio from scratch. And I'm not only going to show you how to exactly do that, but I'm even going to use Warren Buffett as a perfect example of how to do it successfully using the power of dividend growth investing as well. So, if you like getting some educational videos once in a while on stock market investing, then make sure you subscribe and smash that like button. And thank you for that support, my friends. And by the way, I'm going to put chapters for you down below. So if you want to skip to any specific part, you're more than welcome to do that. But the way I'm going to structure this video is we'll start first with a quick intro into dividends and how they work. Then we'll cover what to look for and the different strategies that you can use for investing in them, including, of course, my personal favorite strategies. And then we'll also finish up with a couple of examples of some different stocks that I feel can meet some of that criteria. So if that sounds good, then let's go ahead and jump straight into it. Now, starting first with what are actually, dividends in the first place? Well, very simply, dividends are just payments that a company makes to its shareholders. And the most common form of dividends are cash dividends. So for example, let's say you buy one share of JP Morgan Chase, a very popular bank. It's actually the biggest in the world outside of China. And currently their stock trades for around $270 per share. Well, right now they pay $5.60 per share in dividends. So if you were to hold one share of Chase stock for, let's say, a full year, you would get back $5.60, which is a little more than 2%. That's what we call the dividend yield. And you get that as a cash dividend, sort of like a reward for holding on to the stock and believing in the company. While I have this up though, let me just quickly explain the other dividend metrics on here too. So of course, that first one you have there is the yield. That's the percent that they pay based on the current share price. You have the payout amount. That's the actual dollar amount that they're paying out per share. You have the payout ratio, which is the amount of their profits that they're paying out in dividends. So at less than 25% there for Chase, well, that's very, very attractive because it means that they can easily cover those payments. And in all likelihood, they can actually increase them over time too. Usually a payout ratio of, let's say, around like 50% is considered very good. But at less than 25%, that's extremely good. And it's pretty rare to be that low. But yeah, that just means that that dividend is very well covered at those levels. So they probably won't have to cut the dividend if the company were to struggle a bit. And again, in all likelihood, they'll actually increase their dividend over time, which is the next metric on here, the 5-year growth rate, which is currently at 7.6%. Now that's pretty good. If it was in the double digits, we would say that that's very good. But in the high single digits, I think it's still decent enough. These days, when you consider all of the other metrics that look attractive here for Chase as well, like the yield is a little small there, but at above 2%, it's at least noticeable. You'll notice it when you get that payment. And then you combine that with a tiny payout ratio. That's, again, very, very attractive. And you have a reasonable growth rate. And then they also have 14 years of dividend growth, meaning that for about a decade and a half, Chase has actually increased their dividends every single year consistently. So overall, I'd say Chase is a decent enough dividend stock here. It's not great. It is kind of average, but it's definitely not bad. And the business is very strong. Even, during the financial crisis of '08, they were able to go out there and acquire smaller banks that were failing during that time. The stock usually performs well long term. The yield is enough, again, to notice when you get it. The growth rate is reasonable. And then you have a strong growth history and a fantastic, like, market leading payout ratio. So overall, as a complete package, it's not a bad dividend stock, I would say. With that said, though, there are different types of dividend stocks that can be much more attractive on certain metrics and depending on the type of dividend investor that you are. And so when it comes to actually building out your dividend portfolio, there's really two primary strategies that most investors use, which are dividend income investing and dividend growth investing. Those are kind of like the two different sides of the spectrum. And then there's a lot that kind of goes on in between. But let's just quickly run through each of those and I'll explain how to use them and how Buffett himself even used them to become one of the biggest stock market investors of all time. And I'll break down some different dividends along that spectrum as well. So look, if you're more focused on dividend income investing on that side of the spectrum, then you won't really care as much about the growth potential of a company or their stock or the dividend, but instead you're much more focused on the current dividend yield, with ideally, let's say, a strong track record of paying that dividend to ensure that you will continue to receive all of that income in the future, which is especially important for older investors that might be retired or they just have like a shorter time horizon. And thus, they want to make sure that they have an already high and secure source of cash flow coming in from their dividend investments. So they care a lot more about the current dividend yield. They want that to actually be paying them a decent amount. So for example, we saw how Chase only yields around 2%. Their growth history is about 14 years. Well, you compare that to something like Verizon, a leading telecom giant who does have a much higher payout ratio. It's more than double that of Chase. There's a bit of a trade-off there. And they also have a much lower growth rate of only less than 2%. So very low growth there. It's not likely to get a lot bigger. But the way that they make up for that is with the massive income that you get from them at around 2 decades of consecutive growth and a mouth-watering dividend above 6%. That's about 3 times the amount of Chase. So while they may not be growing that dividend by much every year, well, the yield is already just so high that you can still invest in that stock almost entirely just for that dividend payment that you'll get to collect like every quarter. Dividends are per year, but they're separated per quarter, so you get to collect them more often. Now, look, I know that this is not a perfect example here. Nothing I show you today is really going to be a perfect example of the things that we're talking about, but that's something that you'll just kind of pick up on over time. You'll learn, you'll grow as an investor. And I'm really just kind of trying to show you some different examples here that can at least illustrate some of the points between income versus growth and how to benefit from them. Now, where things really start to get much more interesting, at least in my opinion, is when investors do have a long-term horizon in their investing strategy and portfolios, to the point where they can actually afford to invest in lower yielding stocks right now that can actually grow much larger over time, and they can be patient enough to wait for that. And when that happens, there's actually a ton of power with that type of strategy. In fact, you might think that Warren Buffett himself has always been more of a dividend income investor, but while that's probably true more recently at the later stages of his life, now in his 90s, right? The fact is, though, that when Buffett first started and how he really built up his massive wealth was using dividend growth investing instead. And here's how he did it. So take, for example, Coca-Cola stock. That's currently his 3rd largest holding in his company, Berkshire Hathaway. Well, at the moment, we can see that it only yields less than 3%, right? So it's not like a very high yielding dividend stock. It's kind of just decent with a somewhat high payout ratio of close to 70% and only a low single digit growth rate in the past 5 years. So definitely not a growth oriented dividend stock, not even like a super attractive one in general. You're really not buying this stock today thinking that that dividend is going to grow much larger or that you'll see like massive gains from it, right? You're mostly just kind of getting that yield that is less than 3%, and you'd probably just be happy with that. And hopefully the stock remains kind of stable and can appreciate in price too. However, what you have to keep in mind here is that this dividend has been grown for over 6 decades in a row, over 60 years. And because of that, that yield that Buffett specifically gets on his shares could actually be very different than what any new investor gets today. See, today, Coca-Cola stock trades for more than $70 a share. But around the late 1980s, when Buffett spent $1 billion on buying Coca-Cola stock, he purchased 400 million shares, which he still holds that exact amount to this very day. Well, at that time, Coca-Cola stock was only trading for around $2.50. So if we go back to the dividend here for a second, we can see that they currently pay out just above $2 a share. Okay, we'll do the math here. $2 in dividends on a $70 stock would, of course, give us a yield of just under 3%. So that's what you get if you're a new investor today buying Coca-Cola stock. You get about a 3% yield every year on that investment that you make. But because Buffett bought his shares a long time ago for a much lower share price of around $2.50, his yield is actually gigantically higher at around 80%. Again, Buffett is not buying at today's price. He bought at a way back price that was much lower. So his yield is around 80%. In other words, Buffett initially bought $1 billion worth of stock, right? Well, today, that $1 billion investment from the past is still generating over $800 million per year for him. Guys, in other words, Buffett is almost making his entire investment back every single year. I mean, it's like mind blowing when you think about it. And why is that? How does this work? Well, it's because Buffett bought Coca-Cola when their dividends were very small, but over time, over the longer term, Coca-Cola grew as a company and they increased their dividends for over 6 decades in a row. So every time that they increase their dividends, they also increase the amount of money that Buffett would get on his 400 million shares on his investment. And because he's held on to those shares for so long using a long-term investing strategy, which is what I always preach to you guys, well, not only did his initial stock investment in Coca-Cola go up, from around $2 up to $70 today, which is already a fantastic investment just on its own, just for that, but the dividend also increased to the point where he's now collecting 80% gains every year on his investment. So it's really just crazy when you think about it. I mean, we, more recently, like, especially these days, we talk so much about high growth tech companies and how their stock prices can climb for the future because of like AI and cloud computing and other technologies like that. And yet here we have just a very simple business in Coca-Cola selling liquid beverages in a can or in a plastic bottle. And that company is generating monumental returns for Warren Buffett of just pure cash, 80% on his investment being deposited into his account every year. So that right there is, again, the power of dividend growth investing, and it's absolutely huge. And it's why, in my personal opinion, I think all investors should use at least a combination of strategies, not just stock price appreciation, where you buy a stock and hope that the price alone will go up, or just dividend income investing, where you buy a stock because it currently has a high yield, which can also be very attractive, very lucrative. But you also want to add on top of that some dividend growth investing too, for that potential that, like you saw with Warren Buffett. And when you add all those things, then you can really be cooking with fire here. When you're talking value stocks, growth stocks, dividend income, dividend growth, throw in even a little bit of speculative investing too with some smaller companies. I mean, all of that, that's how you really build up a great portfolio in general. But when we're talking about dividends, look, I'm not a fortune teller here, so I can't give you some perfect examples to what Coca-Cola has been able to do in their lifetime, but I'll try to show you at least some variety of different options, again, across this kind of spectrum here that we have of dividend income and dividend growth. And really, an area that I think is a little slept on right now, I would say, for dividend growth potential is actually in tech, which historically was the opposite, because tech has never really been known too much for paying out, massive dividends. But when you look at some tech giants that just started paying dividends very recently, like Google and Meta, those are giants that are still growing their businesses at shockingly high rates for their massive size. But because they just started paying dividends, their payout ratios are also tiny right now. And I think in the future, they're going to look to compensate for slower growth in their business because they're so massive. There's only so much you can grow. But I think in the future, they'll compensate for that. They'll reward shareholders by increasing their dividends. So don't sleep on it. I think they're actually going to get much bigger. Now, both only pay tiny dividends of less than 1% at the moment. But with payout ratios of less than 12% and 8% respectively, absolutely tiny, yeah, those dividends are very likely going to see a ton of growth long term. And even like Microsoft has a little bit of a higher yield with still a very low payout ratio, a double-digit growth rate, and 2 decades of consecutive growth too. Not to mention that those stocks on their own are already, great investments. I own all 3 of those. So the little dividends are just kind of like a nice added bonus on top of that, with the potential of getting much bigger in the future, depending on how long your time horizon is. But again, I get that their yields are very small. It's not going to be very exciting for new investors to be buying those stocks. And so that's why I own other stocks too that can get a little bit more in the middle of the spectrum and look for some value as well. For example, NextEra Energy, who's a market leader in wind and solar. I'm always looking for market leaders that have stable businesses that will be around for a long time. They have a lot of future potential in renewables, so I have no doubt that they'll still be around. They'll actually grow in the future, in my opinion. And their dividend is a little bigger at over a 3% yield, so a little more attractive there. And they still have a reasonable payout ratio, a double-digit growth rate, and about 3 decades of consecutive growth. Now, for a lower payout ratio, I also love Medtronic, the world leader in medical devices, with future growth in AI and robotic surgery. And their yield is a little higher, with a payout ratio of about 50% and nearly 5 decades of consecutive growth. Ignore that 33 years there, by the way. Seeking Alpha sometimes glitches on the growth history. They almost have 5 decades of consecutive growth. Now, for an even higher yield and growth history, I've recently been buying a lot of PepsiCo stock. And I know that's the rival of Coca-Cola that we just talked about, but a recent dip in their stock price has actually lifted their dividend yield to more than 4%. And that's with over 5 decades of consecutive growth. So that's very attractive to me. And for even bigger yields, I like some stocks like Vici Properties and Pfizer. Now, Vici, for example, is a REIT that owns the biggest casinos in Vegas. It's a cash cow, giant cash generating business, never going away in my opinion. Casinos are here to stay, at least I feel, and resorts and all these kinds of things. Very good properties, still plenty of more room for growth in the future too. And they've grown their dividend every year since going public, with already a 5.4% yield at current prices. And I think that's very attractive too. Pfizer is also the world's largest biotech. They recently saw their stock crash coming off the pandemic, huge crash. And that's now left their dividend yield above 7%, which is extremely high. And look, as long as that dividend remains safe and the business recovers, which I think it will recover long term, because you don't have such a dominant biotech like this just disappear. I think they will recover, in my opinion. But when that happens, I think that dividend is going to get even bigger. And I think that the stock price is going to climb. The yield for new investors will actually go down because the stock price will go up. But I think at current prices, locking in shares now, I think in the future, the dividend yields will be very high. Again, all of this is just my own personal strategy. It relies on a combination of all these different types of stocks, and it also involves a very long-term horizon. So sometimes people don't like to hear me talk about stocks because I like to invest long-term, and a lot of people just want instant gratification. They want to buy a stock and immediately become rich. I just feel it doesn't really work that way. So I don't know. I'm going to be honest with you guys and tell you how I feel it really is. But yeah, that's how I've found success in the market. I've always done well for as long as I've been investing, over 2 decades, something. And I'm going to continue to do that well into the future. So anyway, I'd love to hear what you guys think about all of this. What types of dividend stocks do you like investing in? Are there any that are on your mind that you'd like to pick up? Let me know down below. And if you have any questions, drop them down in the comment section. I'd be more than happy to help you. I know dividends can be a little confusing. It's hard to articulate some of this, but if you have any questions, I'll try my best to help you out down in the comments. Thanks again for stopping by, my friends. I wish you the best of luck out there. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.